Thank you very much for giving me the opportunity to speak today at the Master Investor event. My name is Jason Baggaley. I'm a fund manager of the Standard Life Investments Property Income Trust, otherwise known as SLIPIT. I'm going to spend part of the presentation talking about how we're seeing changes as a result of the current environment coming through into the real estate market in the UK. And then I'm going to apply it to the fund and give some examples of how we apply the theory into the practical. So slide 2, please. As you'll be very aware, real estate's performance is correlated very closely to that of the economy. In the short term, the economy is likely to provide challenges to returns from real estate. If we think about bank lending, the general corporate environment, consumer spending, all challenged in the short term. So that will depress returns. However, as we go back into economic growth and recovery, so the returns will come through relatively quickly into real estate. And slide 3, please. Now, those returns aren't going to be equal. The move into growth is going to be actually quite spread. So we expect to see different cities come out and improve at different times. We expect to see different sectors improve at different times. Even within a sector such as retail, the spread will be quite wide. One of the key drivers of performance in real estate, obviously, is rental income. And if we look across the spread of tenants across portfolios, some are going to struggle for quite some time across all sectors. And so resilience of income will be very important, making sure we have tenants who can afford to pay rent. Now, obviously, we're in a period of rapid change at the moment. And there's been an acceleration of themes through COVID. So work from home is probably one of the most obvious ones, which we're all experiencing at the moment, or many of us are experiencing at the moment. As we move back into normality, the chances are many of us will still work from home some of the time. Now, that's got another connotation, actually, of one of the changes we've seen, obviously, through lockdown, is a rapid increase in the penetration of online retail. Actually, I expect that to remain relatively high after COVID, partly because if we're at home 2 days a week, we finally found a much more convenient solution to that last mile delivery, because we can accept it at the front door. In fact, many of us have had numerous interruptions to our online Teams calls and Zoom calls because the doorbell's rung from parcel delivery. Hopefully that won't happen in the next 15-20 minutes. And as we recover, not all areas will recover at the same speed. So over the last 5-6 years, it's been relatively easy. You know, you said industrial's being good and retail's being poor. And although those themes were likely to continue, within sectors, we think there's going to be a much greater diversification of returns. So perhaps looking at the retail sector in particular, convenience and food performance is going to be far, far better than fashion, for example. Next slide, please. So just looking through the sectors and what's going to drive change, I'm going to start with logistics because obviously it is everyone's favourite at the moment. It has a fantastic following wind and we think it's going to continue to perform well. But some caution is needed in the short term. You know, if you think how many occupiers supply retailers who've now gone bust. So there will be some challenges through the general economic environment, but generally it's a positive story. Ongoing changes in technology, use of e-commerce, probability of a move towards more localized storage and maybe even manufacturing as well, supporting it. Although in the shorter term, what the impact of Brexit will be on, say, the car industry might also impact supply in some areas. ESG will be central to performance in logistics as we move towards a world of more electrification of supply chain, etc. That has power implications as well. So some ESG drivers through into the sector. And next slide, please. So onto the office market, an area of huge debate over the last few months. Let me set my stall out. I do not believe the office is dead by any imagination, but in the short term, it's going to suffer from a lack of occupier demand in particular. Apart from anything else, we're likely to see, as unemployment rises, less people in employment to sit in those offices, so less need for space. We've already seen examples of expansion plans being shelved, apart from anything else. We're likely to see people working from home a little bit more. That will lead to some longer term structural decline in the amount of space needed, partially offset by a reversal of the trends of densification of occupation that we've seen in the past. So people will be given a little bit more space in the offices. Now, the long-term drivers, actually, some of it's going to be a bit more positive through uses of some of the technology in buildings. The way people work, we're going to have to create spaces. And if we move to the next slide, what I've tried to do is to give a feel for the factors which we use to assess whether or not a building is going to have a place in the future, because I think we're going to get great diversification between buildings which need occupier needs and therefore do well, and buildings which don't and therefore do very badly. So great spread in returns. But the types of things we're looking for are an office which will make people want to go to work in it. So that having the right amenity, the location convenient for them to get to, etc. So creating an environment which the occupier benefits from being in, and can fulfill people's needs for collaboration, learning, growth, etc. And the sustainability angle there is quite important, both in terms of wellness. So, one of the things we have in a number of our buildings are yoga classes in shared office space, etc. But also air quality will be very, very important. Sustainability will be another leading factor in the use of offices. Technology has quite an impact as we become more flexible in our workspace. We will be going to the office to undertake specific functions. We want a smooth and easy transition into that. So as we're approaching, we should be able to have a seamless entry without having too many touch points, queuing, waiting, but also desks or meeting rooms booked for us, close to or with the right people. And next slide, please. Residential has never really featured as a main sector in the UK investment market. That is changing. And I use the word residential as really meaning the whole gambit of beds. Be that healthcare, student accommodation, obviously flats, rentals, hotels, aged care, etc. So it's a very wide-ranging but growing sector, and growing in importance. And it's also going to undergo change as a result of COVID. So how we design accommodation to suit people being able to work from home a bit more, that may be within the flat or it may be within the complex. So having shared amenity space where people can still interact with others and work comfortably and efficiently, as an example. And next slide, please. And so we started with the darling, and we'll finish with retail, which has obviously had a torrid time, and is likely to continue to face difficulties into the future as well. Physical retail is very challenged, and there's not much which one can say positively to change that. I mean, some areas will do well within the sector, undoubtedly, predominantly convenience and food led, but also experience. So the social aspect of retail will remain important. But we have an oversupply of retail accommodation in the UK, and rents will be challenged. Next slide, please. So that was a run through sort of the themes we see affecting the sectors. I'm very fortunate to manage the Sundance Investments Property Income Trust. It's a listed REIT, so a closed-ended vehicle. Liquidity is provided by dealing daily in shares on the London Stock Exchange. I don't need to worry about holding lots of cash to meet potential redemptions, or indeed I don't need to be influenced by having lots of money coming in or going out of the fund in different styles. So I can invest with more of a free range, I guess, and less liquidity driven. As a result of that, we several years ago sold out of retail to a large extent. We've been at about 8% for a while. Having been rude about retail for the last 15 minutes, the last asset I bought only about a month and a half ago was a retail asset. It's a retail warehouse unit with fantastic, strong income credentials, very attractive yield, and some alternative use protection, I guess, for the future. But we sold down our retail exposure quite a bit, and we had a high industrial exposure that served us really well. And I think it will continue to do so. But certainly, if I think about all the things we've spoken about, they're not just about sector, they're also about asset. And our focus at the moment is very much in analysing every asset, taking a step back, forgetting how we felt about something a year ago, and really reassessing for today's conditions to make sure it's going to meet our future needs. I want to just pop in a slide about performance, because our medium-term performance, and actually up until the beginning of this year, performance has been really quite good, partly because of our asset allocation and very active approach to managing the assets that we've had. All of our underperformance in the short term came in Q1 this year, where quite frankly, right, every asset was written down in value, and that applies actually over the first 6 months of the year. What we felt, and the valuers felt at a time of great uncertainty for valuation, very little transactions, was that the environment we're in at the end of March was very different to the end of December. And so we've got a short-term dislocation compared to the market. I wanted to mention that because having talked about the things we're doing, I feel that we need to be very cognizant of the fact that we've underperformed this year, which is quite upsetting. Next slide, please. So I'm going to sort of wrap up with trying to bring what we've said to what are we doing today, what do we think is really important to be focusing on. And I'm going to start with ESG. I think it's going to be a focus of even more attention post-COVID. I think it's going to be something which will drive performance. And it's something which, on a personal level, many of us are very keen on. We've started through photovoltaic installations on buildings. We've done a lot of that. In fact, we've got the largest PV scheme that ASI has done in the UK in the fund, and we're trying to do more. But we have to keep driving that agenda, moving towards carbon neutrality, etc. Really fascinating area, and one which will drive performance. One of the things we really try very hard in this trust is to ensure that every asset we own for a purpose, that we understand why it's going to appeal to a tenant. Affordability is a big part of that. We very often buy great quality accommodation just off prime, where we know that the tenants can make money, be that as an office or a retail unit. And actually an example I'd give is in retail, we had a tenant go into administration and fail. We had 3 other retailers offer very quickly for the unit at the same rent as the previous tenant, because they knew that they could make money at that level. I think that's a really important factor, and it applies to offices as well, and industrial. We need to offer flexibility to our tenants. In an uncertain world, they're unlikely to want to commit to very long leases. If we believe in the quality of our accommodation and we can provide tenants with what they need, we shouldn't be worried about shorter leases. And usability, it comes to making sure we have functional space for the tenants. And one of the things we've done on our offices, for example, is fit them out so that they're very easy to move into at low cost to tenants. And that's proved very beneficial to us. We've talked about the top-down themes, and I benefit at ASI of a very strong research and strategy team to help. But really, the performance of real estate is going to be bottom-up, asset by asset, understanding how it's going to perform, whether it's going to meet future needs. which I think is fascinating because it gives us an opportunity to continue to evolve as the market does in these challenging times. And we are very hopeful that we can continue to provide not only decent returns to investors, but real estate, which helps meet society's needs. Thank you.